Hey, welcome back everyone. It is time for another red hot cover call video. Well, hey, look, today we're going to talk about two dividend paying funds that I invest in, QQQT and QQQY. We're talking about these two because I own them and my kids own them. But we really want to talk about these two largely because of the strategy they use and QQQY. Because QQQY is the poster child for NAV erosion. So in this video, we're going to talk about why these high-yielding dividend-paying stocks NAV erode. You're going to learn about net asset value and how these funds lose their value and their stocks fall. And then they usually reverse split and everybody goes crazy. So today, let's talk about these two funds, why I like them, and more importantly, what they do to derive their dividends. So look, if you've never been to my channel and you like what you're hearing, go ahead and subscribe to the channel. And if you like this video today, bang that like button. It lets me know you like what I'm doing. And what I'm doing is this. I'm talking about QQQT and QQQY. When you invest in these high-yielding dividend funds, you need to understand how they derive their dividend. Because if you don't, what's going to happen is when they pay you those big dividends, you're going to be happy, but as the stock falls, you're going to be kicked in the ribs because your overall investment is going lower and lower and lower. You don't know why it's going lower because you thought dividend-paying stocks pay you a dividend and you're not supposed to lose money. Well, that's not how it works. So let's talk about this. I invest in both these. I love QQQT and QQQY. Reason I love them is because they use monthly and weekly covered calls. What I'll tell you is this before we get going. Everybody hates QQQY and IWMY and all these dividend-paying stocks that started out at 20 bucks and they found themselves at $9 and $8 real quick. And of course they reverse split and now people are upset they have half their shares or a third of their shares and they just don't understand why this happens. Well, that's what we want to talk about today. So QQQT is a monthly dividend payer. What it does is it buys the NASDAQ being the NASDAQ 100. It buys the underlying ETF, and then it writes near-term covered calls, weekly covered calls, and what it does is it pays its dividend monthly. So they've been averaging about 32 to 33 cents per share per month. And it's really steady, Eddie. I'm going to show you the chart here in a minute. I like QQQT because of that. See, steady investments I absolutely love. Everybody on YouTube is talking about getting rich with all these high-yielding dividend-paying stocks like Misty and Nvidia. Well, what happens is they release these stocks at $20, and when they pay a $1, $2, and $3 dividend, the stock immediately falls minus that dividend. So now where they were sitting with a $20 stock, they're sitting there with a $17 stock. Now, yeah, they were handed $3 in dividends, but they don't see it that way because they spend that dividend. But yet they're now holding a dividend stock that's down $3 a share. So that is what we're going to talk about here, and that's why QQQT is a steady payer, monthly payer, about 32 cents a share. QQQY, they're a weekly payer now. They used to be a monthly payer. Now, they were so aggressive in the process of creating that dividend and giving back their investors all that money, they literally were giving $1 dividends every single month on a $20 stock. So it didn't take long before they had to reverse split the shares and then change their entire strategy. Now they're a weekly dividend payer, but they use daily covered calls. Now, we're going to talk about how they actually derive their dividend, but that's basically what these two do. They use options and pay their dividend to their investors. And those dividends are still pretty big. 32 cents for QQQT is a lot when you compare it to old closed-end funds that used to pay just 9 cents. Now, QQQY is weekly, and they pay around 27 cents on average per week. Let's go ahead and look at one more thing before we move on. Notice the net asset value, NAV. Notice that QQQT's net asset value is 19 million. QQQY is 158 million. That's their net asset, right? They have money and they use that money to buy ETFs or buy call options to create a synthetic trade, and they write covered calls. When they generate premium profit, they give that back to the investors. Their net asset value is money. In the case of QQQT, they actually own the underlying ETF. These high-yielding dividend-paying stocks use cash to derive that dividend. You could see that QQQY uses the same strategy, little different. They do daily options where they're really counting on time decay in that option to make it very profitable. Let's go ahead and take a look at how they derive their dividend a little bit further. If you're not an options trader, you won't understand this. I'm going to tell you, you need to know, because I don't want you buying either one of these if you don't understand how they derive their dividend. So in the case of TQQQ, they basically generate their income selling covered calls on the NASDAQ. They buy the underlying ETF and they write near-term covered calls. Now they're pretty much at the money or near the money. Now what they do is they leverage time. They're using time decay to their advantage. But they are doing weekly covered calls, so they have about 5 days, and their options have a little bit of time value premium in those options. Now what they do is they pick very tight strike prices to where the NASDAQ is trading. What happens is they limit their upside. When the NASDAQ shoots higher than their strike price, they don't make anything above their strike price, limiting their upside. So what QQQT does is they buy an out-of-the-money call option. So once the NASDAQ goes above their strike price, that near-term covered call ends, but their out-of-the-money call option they purchased still makes money. They're letting their winners run. Now, that's the basic strategy for QQQT. They do weekly covered calls. They have weekly time decay. So they generate about 32 cents per share per month. Now, QQQY does it a little differently. And mind you, they used to be a monthly dividend payer. And they use a synthetic trade for which they did not own the underlying ETF. So their net asset value was 100% cash and the little bit of collateral they had to buy, plus the call option to create the synthetic trade. They were spinning out tons of money, and it caused QQQY stock price to fall incredibly hard. People were buying in at 20, and it didn't take long before it got to $10, and everybody's moaning. Well, it's because they distributed those dividends every single month. I'm going to show you what they distributed here in a moment. It's incredible. What they had to do was reverse split the stock, and then they changed their strategy. They became a daily covered call options trader, and they paid weekly. So they've shifted their entire format to where they're weekly now, and they're using time decay to their advantage. Now, when we write daily covered calls, we don't have as much time value premium in our options, so they don't make as much. So that's why their dividend is different now. See, even though they've reverse split, their net asset value did not change. The money for which they were trading did not change. It did not reverse split. But the strategy changed. So those that are critical of QQQY and IWMY, those that reverse split, the cause and effect is that you'll get less of a dividend. Well, that's not true with QQQY. They changed their entire dynamic. They're using daily covered calls. The time value premium is smaller. The time value premium in a daily covered call is smaller than a weekly covered call. So right off the bat, the dividends they pay are going to be smaller. Now they're going to pay them more frequently. See, now what they want to do is give you that weekly distribution of about 27 cents. And to be honest with you, on a reverse split adjusted price, $30 QQQY, you don't really notice a 27 cent dividend every single week. Because the NASDAQ could actually be up on a day for which they give their 27 cent dividend, and maybe QQQY goes higher 50 cents. Did you notice the dividend? You didn't. You got it, but you didn't notice it in the share price. That's what QQQY tried to figure out, and they're trying to fix. Because they have incredible NAV erosion because of the old strategy. Now, they both use time decay, and that's how they generate that profit. That profit is distributed to their investors, and those are the people that own these two funds. Now, we're going to take a look at each of these charts. You can see QQQT has paid $1.92 back to its investors since its inception. And you can see the NAV erosion doesn't look so bad. It's a pretty decent stock. It pretty much moves with the NASDAQ, and it pays a decent monthly dividend. Look, if you owned 1,000 shares, you'd collect about $320 per month, and that's not going to cost you much. QQQT trades for about 17 to 18 bucks. You could actually get about 2 to 3 to 4,000 shares. Next thing you know, you're making about $1,000 on a steady Eddie trader. To the left, where the stock fell considerably, it's mimicking the NASDAQ. And when the NASDAQ rallies back into the new year, it does the same. QQQT has a wonderful chart, but QQQY is incredibly scary. Let's take a look at that one real quick. You could see that it is the NAV erosion poster child. It has paid this incredible dividend, for which I'm going to show you here in a moment. They've paid this incredible dividend month over month until they had to change something. They went live at 20 bucks, and it didn't take long before it was trading much less. Right here on screen, you're seeing a reverse split adjusted price of 30 bucks. This thing used to trade at 20. And if you owned 1,000 shares, you'd have invested $20,000. Now that's important because we're going to talk about reverse split and how I believe in the long run, you're going to make quite a bit of money with this strategy that they're using today. I'm going to break it down, so stick with me. But you can see with every single dividend, the stock would fall based on the dividend. And those dividends were $1, $1.20, 90 cents. Well, it's going to fall when it's a $20 stock. It's going to fall that much. And because it follows the NASDAQ, for which is not that volatile, when you think about the 100 stocks inside of it, it never had a chance to recover before they distributed the next month's dollar dividend. So this is where we get net asset erosion. Now, erosion is a word everybody loves to use, but the reality is it's a distribution. See, they took their net asset, which was all the profits that they made off of writing the covered calls, and they distributed to their investors. People use the word erosion because that's what that looks like, doesn't it? Well, they had to come up with a plan because this thing was going to go to zero. Because at the end of the day, they weren't going to change their investment strategy and how aggressive they were selling options against the NASDAQ. So they had to reverse it because the NASDAQ does have rules, by the way. They will delist you. And particularly a stock that goes from 20 to under $5 that quick, yeah, you're going to be on the list to be delisted. And these funds make the companies that manage them a lot of money. Takes a lot to have one of these funds on the stock exchange. So they're not going to lose it. So what they're going to do is reverse split it. Well, that gets people crazy. Because now what happens is, if you had 1,000 shares and they reverse split it 3 times, you only have 333 shares now. And that drives people crazy. Talking about NAV erosion, we're gonna talk about that $158 million that makes up their net asset value. But why does NAV erosion happen? Well, this is a perfect picture. When you are a $20 stock, now I know it says 30, but mind you, they've reverse split it at 3 ways. So this thing was trading for $10 when they reverse split and changed the strategy. They paid $2.25 in May. So if you are a $12.25 stock and you pay your investors $2.25, you now have a $10 stock. This thing was going to nothing. So they were going to have to reverse split it. Now, I give these folks a lot of credit, and this isn't a paid advertisement for them. They knew what they had to do. They had to reverse split it to get the price up. Then they went to weekly covered calls. And we talked about that. They're going to pay a little bit more, but they're going to pay weekly. And NAV erosion isn't as obvious. Now, this is what I want to show you. This is QQQY's distributions. This is all of the distributions since the fund went live. Now, I've highlighted a few things here. It started out as a $20 stock. You could see here at the top, $20. And prior to it reverse splitting, it paid all of its investors $9.24. So that pretty much means the stock market was sideways to higher during this because the stock didn't fall that much. It fell because of the erosion of the NAV. All those dividends that kicked back to the investors. Look at the monthly payouts. $1, $1, 93 cents, 62 cents, 85 cents. They're paying way too much out. but that was the aggressive nature of the fund. This is where, if you don't know how they derive the dividend, you're getting kicked in the nads, because by the time we get to the reverse split moment, it's trading for 10 bucks. So what do? They go ahead and reverse split it, and now look what it does. It's still a monthly. It's still a monthly stock. What does it do? Because it still has that $150 million in cash. Remember that big old stack of cash that they used to write covered calls with? Well, they still have that. Yeah, the stock got reverse split. You went from 1,000 shares to 333 shares, but they still have that stack of cash. So they're still writing covered calls. And look at the first dividend, $3.46. So the strategy didn't change. You got reverse split, but you still got the same amount of dividend. So for anyone that says a reverse split means you get less dividends, they don't know what they're talking about. What happens is they change their strategy, and they change a strategy for which they have no time decay in their options. They're using dailies now. So now the dividend is going to be smaller, and you can see what they're paying. The very next dividend is $1.99, but that's when they start the weekly. And then after that, look at those weekly dividends coming in anywhere between 34 cents to 28 to 27, 26. It goes back to what I said. You may not even notice that dividend coming out of a $30 stock. Now, what I want to share with you is this. At this moment in this chart, you got $18.80 back in your investment. Remember I told you earlier that $20 was a big number? That was a very important number, because that's what you paid per share. And they paid you $18.80 back. So if you think of it that way, you're only in the hole $1.20. You bought the shares at 20 bucks when it came out. They reverse split it. They did all this. You're literally only down $1.20 because they paid it all back to you in cash. Now, I'm going to show you what I believe is going to happen. So I want you to stick around. A lot of people say they will never make their money back. This is going to zero, this, that, and the other. That is not true. They're going to reverse split it every single time. And I'm going to show you that your shares will be reverse split, but you won't go broke. Now let's go ahead and finish up this video. I ran some hypothetical numbers. And do understand, I own QQQY. This is what I believe. I believe we will not lose our money. In fact, we will make more than 100%. Remember, we invested $20,000 for 1,000 shares. So taking a look at where we're at today, as of right now, we've been paid $18.80 of our $20 per share. Now, I know that doesn't make anyone happy because you probably spent the money just like me, but that's the fact. But at this point, we have 333 shares. They reverse split the stock. It's trading for in and around $30. So right now we have $18.80 back in our pocket. We're only down $1.20 from our original investment. Let's take a look at where I think this goes. So the premise is simple. $20,000 invested. The stock has fallen. They reverse split it. That's the moment where you went from 1,000 shares to 333 shares. Let's hypothetically say week one, we're now trading at the reverse split adjustment of $30.29. And what we're going to do is make a hypothetical assumption that we're going to get paid 27 cents per week. That's actually under what it pays, and most of the time it pays more than 27 cents. But we're going to aim low here just so we can really make a point. So looking at the first 52 weeks after this happens, this is what's going to happen if the stock market stays steady Eddie, zero up and zero down. All they're doing is taking the dividend, and they're paying it back to you. It's going to be 27 cents per share. So what you're seeing here is everything times 333 shares. So over the next 52 weeks, you will collect some $4,675. Now, when we add that to the $18,800, we're already over 100%. In fact, now we're 30% higher. We got all of our money back, and we're now making money. Now we continue, and we're going to reverse split this thing again when it hits 10 bucks. So going into the next 52 weeks, you can see the stock is falling by 27 cents per week, and we get to that point where the stock's trading for 10 bucks, and they reverse split it again. you have 111 shares. And since then, you've made an additional $2,157. We're 24 weeks into this new year. Well, now you have $25,633 back from your original $20,000 investment. But let's continue. We're going to get to that 52-week mark, and you can see the stock's trading for $22, and we've made back another $800, and now we have $26,000 in our wallet, and they will reverse split this again. So what we have to do is just understand it, understand the investment, so you can feel good about it. And looking at that chart, you could see to the right, it's kind of flattening out. And you could see it falls below support because the market has fallen lower. So I think in the end, you're going to find that stocks like this will figure it out because they don't want to lose the cash cow for which it is. See, they're generating fees and they don't want to give it up. So they're going to figure it out just like QQQY has. They went from a monthly to now a weekly. They've changed the strategy where they do dailies, and they're generating a very healthy 27 to 34 cent dividend per share per week. Hey, look, I'll tell you this. This is my dividend tree. I actually own these two, and I own quite a bit of them. I plan to add more of QQQT because I really like its 32 cents per month per share, no NAV erosion. But I'm also going to buy QDTE because that one is a dividend payer that pays once a week. They have almost no NAV erosion that you can notice. See, that's the key. When they distribute those little bitty weekly dividends, you don't really notice it because the market could actually be up and they can distribute their dividend and then be up on the day. Hey, look, I have a membership and I talk about this all the time. The dividend tree idea is what I do. I write covered calls, I sell cash secure puts. We literally print money. We take that printed money and buy these stocks. These are passive income investments, and I get paid weekly and monthly. And I'll tell you what, at the end of the day, my members see all of my trades on the covered call and the cash secure put side to generate all those juicy premiums so they can take all of them and buy dividend paying stocks. I'll tell you what, I want you to join the membership. I have a free month offer in the description below. I write covered calls and sell cash secure puts to generate money you did not have, money I did not have. Then I take that money and buy dividend paying stocks. I call it my dividend tree. And what I want to plant multiple trees just like I have here. These are all dividend trees and they all produce a cash dividend fruit. And what I want is 30 of these trees in my dividend tree grove. So I want you to click in the description below, grab your one free month offer to my membership, see how I trade all of my kids' accounts, and I buy them dividend paying stocks. And you get exclusive videos you don't see here on YouTube. We're talking about all of this stuff in the phone app that you get for free. Hey, look, I'm going to leave it right there. I do hope that when you go and buy these dividend paying stocks, you truly understand how they derive their dividend because that's the most important. And all of my members get the good dividend stocks that I have vetted and I am now buying. Of this list, there's some ones there that I am going to sell because I want to avoid single stock risk. And you can see them there. I know if you've been watching, you know the ones I'm going to dump because I want indexes. I want those high yielding dividend funds to own the ETF, and I want them to pay steady Eddie, reliable dividends with little NAV erosion. Join my membership. You'll get to see it all. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.